I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Warren Buffett, otherwise known as the Oracle of Omaha, is arguably the greatest stock market investor of all time. Given his notable reputation, when Warren Buffett includes a stock in his Berkshire Hathaway portfolio, it indirectly sprinkles praise on that stock. So in this video, I'm going to highlight two such stocks that are in Warren Buffett's Berkshire Hathaway portfolio that I think are good bargains for long-term investors. The first stock I'm going to talk about is StoneCo. StoneCo. This stock is down 89% off its high, and I think this is one stock that's included in Warren Buffett's portfolio that I think deserves a spot in your portfolios as well. Now, let me talk a little bit about why I think StoneCo's stock is down so much. And it goes back to the company's latest earnings report, where it reported total revenue which increased by 28.2% year over year. Now, that was a slowdown from the previous rates of growth that were significantly higher. Still, net income for the period of 307.2 million compared to a loss of 489 million in the second quarter of the previous year was a significant improvement. But again, investors focused more on the decelerating revenue growth on the top line than they did with the improving profitability on the bottom line. Also, net cash provided by operations increased to 832.5 million. That was up from 714.6 million. Again, improvement in what is my opinion a more important metric, which is the cash flow from operations. I value that more than I value revenue growth. Also, finally, the company's forecasting third quarter revenue growth of 23%. And what you'll notice here, I mentioned already, the 28.2% revenue growth was already a slowdown from previously higher revenue growth rates. And now management is forecasting even lower revenue growth in the third quarter. So this downward trending revenue growth is concerning stock market investors, which already came into 2023 skeptical about growth stocks because the Federal Reserve in the US and central banks around the world, for that matter, have increased interest rates significantly over the last year and a half. And so costs of capital are rising, and that tends to hurt growth stocks more than non-growth stocks, more mature companies. If we dig a little deeper, however, and we look at what's the underlying cause of StoneCo's slowing revenue growth, you get a better picture of the company and what's happening. Now, management noted they're taking a concerted, a purposeful, a proactive change in the type of customers they're going after. They're now going after more smaller customers that provide greater profit margin than larger customers that offer lower profit margins. So let's dig deeper here in these details I have pulled up for you. So the company breaks down their accounts between MSMB and key accounts. Key accounts are larger customers. MSMB are smaller micro customers. And what you notice here, if we look at the breakdown between the two different types of customers, key accounts decreased to 14.1 billion total payment volume, which was down 32.5%, whereas the micro accounts increased by 19.3% year over year. And you can see the active payments client base, so this is just active customers. You can see micro customers increased by 43.3%, or smaller customers. You could think of it whichever way. I like to think of it as like micro businesses, extremely small businesses. And then their key account customers only increased by 2.2% to 62.6 million, up from 61.2. So you could see this trend in management focusing more on attracting these smaller customers. And if we look a little bit lower, you'll see very clearly why management is doing this. Now I want you to focus on the take rate here, and you look at the MSMB and key accounts and look at the difference in take rate. For MSMB, the company makes the company made 2.48% in take rate, whereas for key accounts that was just 1.14%. So MSMB customers are more than twice as profitable as key account customers. Now the take rate is what StoneCo keeps for itself from total transactions. In other words, think of it like when you use your Visa card and you go to the store and you spend $100, Visa doesn't get that entire $100. Visa takes a small percentage of that, typically around 3% is Visa's take rate. So similar to that, what the take rate is for StoneCo. People use StoneCo's services to conduct transactions, which you see up here, the total transaction value, the total payment value. And then StoneCo takes a percentage of that, anywhere between 1% and 2.5%. But for the smaller customers, those fees are higher. And so StoneCo makes more money from those smaller customers. And that's why management is more focused on the smaller customers and is saying, okay, you know what, we're not going to focus so much on those bigger customers. And so that's leading to a slowdown in the revenue growth, which I'm okay with. I like that strategy. I've always favored going after more profitable customers. I'm not a fan of going after customers just for growth and just so you can report increasing customer counts when those customers are not going to be profitable. When you're spending money on sales and marketing and all of the things that go along with attracting customers, when in the long run those are not going to be very profitable customers. I'd rather not have those customers. And so I'm a fan of this strategy shift by management, and this is one reason why I've been recommending StoneCo stock. Also, if you look at the company's cash flow from operations to sales, you can see it's been growing nicely since 2019. You can draw an upward trend line here. The company generates 21% of its sales turns into cash flow. And given the shift in strategy focusing on more profitable customers, I suspect I wouldn't be surprised if this percentage increases going forward, because now each customer that they attract is going to be more profitable, more lucrative. And finally, the last reason why I'll highlight why I really like StoneCo stock is because of the attractive valuation. The stock is trading at a forward price to earnings ratio of 10.59, just 10.59, which is a cheap valuation. And this would be cheap for a company that's not even growing revenue, right? This would be cheap for a company that's like growing revenue at 5 or 6% per year. But StoneCo is still growing revenue north of 20%. The company's profitable on the bottom line. Profits are increasing. Cash flow is increasing. You're getting all of that, and you're getting it at a valuation of just 10.59. So this is, in my opinion, an excellent Warren Buffett stock to add to your portfolio. Okay? Now, let's move to the next company which I'm going to recommend, and that is New Holdings. New Holdings stock is down 41.86% off its highs in recent years, and it's in a similar region, right? It's in Latin America. Both of these stocks are Latin American stocks. You've heard me talk about Latin America and that region. I'm bullish on that region. Growth prospects in that region look really good. And so I'm attracted to stocks that operate in that region. New Holdings and StoneCo are two stocks that operate in that region. Again, let's look at the company's latest results to see why maybe the stock is down. And you can see the company posted 1.9 billion in revenue, which was a 60% increase from the second quarter. Net income increased to 225 million compared to just 30 million. New Holdings added 4.6 million customers in the second quarter and 18.4 million year over year, reaching a total of 83.7 million customers globally, and this was by June 30th, 2023. Monthly average revenue per active customer reached $9.30, and that increased 18% year over year. Now, the reason New Holdings is experiencing a stock price decline is similar to StoneCo, although not as severe in terms of the slowing revenue growth. But also, the company is so large that investors are extra concerned about this company because it's saturating the market. There aren't very many more customers to attract after it's already reached 83.7 million customers, right? So one thing New Holdings is doing to counter those concerns is international expansion. So it's expanding to areas outside of Brazil, which is its core market. In Mexico, its customer base grew 33% year over year to 3.6 million, and in Colombia, it grew to around 700,000, which represented 133% growth. So the trajectory in both countries will likely accelerate with the launch of digital savings accounts in those local markets. So in Mexico, in just 1 month after its public launch, Cuenta Nu crossed the 1 million customers milestone. So not only is its international expansion already growing nicely, but Nu expects this growth to accelerate as it has introduced this new savings account. So investors can look for this as a catalyst for growth to continue for New Holdings. And similar to StoneCo, you can see New Holdings has done an excellent job increasing its cash flow from operations to sales. And you'll know that this is an important metric for me because it tells me how lucrative these sales are. Are they turning sales into cash flow, right? If sales are not turning into cash or sales are not turning into profits, I don't value those sales as much as I do the sales that are turning into profits or cash flow. And New is even better than StoneCo at 48% cash flow from operations to sales, and that has increased tremendously since January of 2022 when it was negative 250%. Valuation is nearly twice as expensive as StoneCo at a forward price to earnings of 20.28, but still in the grand scheme of things, when I look at the company's revenue growth, when I look at its customer growth, when I look at its profitability, its cash flow from operations to sales, I'm willing to pay a higher price because its performance is so much better. And a forward PE of 20 for a company with these metrics is still a bargain in my opinion. So I've just highlighted two stocks that are in Warren Buffett's portfolio that are down significantly off their highs that I think deserve a consideration, deserve a spot in investor portfolios because of their excellent metrics, their cheap valuation, and solid growth prospects. Again, let me remind you before you go that if you've enjoyed this video, which you probably have if you've made it this far, then please hit that subscribe button. It'll really help support videos just like this one. Thank you for watching.